Joining us now, Jason Trennert, Chairman and CEO at Strategas, a Baird company. Jason, I guess we are going to start where Joe was talking about earlier, which is the rising yields. How much of a challenge is it to stocks right now?
I think, listen, for the Magnificent Seven, I would argue it probably doesn't matter at all. Like, I wouldn't short those stocks if you put a gun to my head because they're generating a ton of cash. The problem is that, in my opinion, if you look at the Russell 2000, there's about 40% of the companies in that index that haven't had a profit in the last 12 months. So there are pockets of the market that have been built on the kindness of strangers, that have been built on free money. And so for the lower quality companies, a backup in long-term interest rates, it's hard to deny that it makes a difference. But for the leadership, I'm not sure it makes much of a difference because these guys generate so much cash, so they actually benefit from higher interest rates.
So you just skipped, you went from the big seven to the 2000. What about all that space in between?
Well, and then I mean, it's a cliche, but then you're going to have to be, kind of an old-fashioned stock picker and see which companies have been managed well. I mean, a lot of companies have done a good job of terming out their debt, like unlike Uncle Sam, which we could talk about, but 60%,
I definitely want to get there.
60% of our debt matures in the next 3 years. But a lot of companies are better off, or are better able to deal with that have managed themselves well. But there's been an awful lot of companies that have been built on the free money we've seen during the QE era. Let's
do the Fed, and then we'll do the fiscal side.
Right.
Joe thinks that Powell ought to hang out a mission accomplished sign in Jackson Hole, get on the aircraft carrier, and
that's what I'm worried about.
Victory.
Yeah, how'd that work?
I'm if you're asking me what my view is, especially with long-term interest rates backing up, that's also going to help. That actually, in some ways, more.
And the stock market coming down is a tightening of financial conditions.
So that's helpful. I would be careful about the mission accomplished idea, and the reason being is that one of my partners, Don Rissmiller, is our chief economist, looked at 2,000 years of history, to the extent to which you could find all that history of inflationary periods. And what we found is that in all but 15% of the times, inflation tends to come in waves. And there are reasons for that. And I would say that's especially true when you have large government spending. A lot of government spending is indexed to inflation, especially if you have unionization. You get a wage price spiral. And so there are things that are automatic ways in which the inflation can compound on itself, and I think that there is an element of truth in that right now. So I wouldn't put out the victory sign, the mission accomplished sign, but certainly he should be slowing it down as he is. I think, but they should also say that they're.
Have you moved a lot of money into the fixed income? Do you do those things?
I have not, and listen, I've been, you and I have talked about this. I've been more cautious, but. I haven't sold a lot of stocks. I've just been much more cautious about what I own. But listen, 5%, you're getting something in the order of 5% short-term money.
You would do short-term, though. See, people are saying you should do long-term, which is, I don't know.
The federal government should be, 2 weeks ago, Janet Yellen issued $850 billion worth of bills at 5%, when she could have issued $850 billion worth of 10-year treasuries at 4%. Why? I have no idea.
Can I explain that, Jason? I don't want to interrupt your time here, but
please explain it to me, because that doesn't make any sense to me.
A couple things are happening. One is that because of the debt ceiling, the percentage of bills compared to the total was drawn down compared to average. They're issuing bills right now to get it back up to that 15 to 20% average. The other thing that well, I'll tell you why. Because over the history of time that I've been covering this, which is a couple decades now, the Treasury does not want to game the market. The Treasury wants to be a reliable provider of securities and not play the curve. So over time, what it's going to do, what it says it's going to do, what each Undersecretary of the Treasury has told me, or for domestic finance has told me, is that we will do in regular proportions. We're not going to go at a time of low interest rates and go term out our debt so that we're seen as a reliable partner to the market.
There's
That's what they've told me. Is that the right thing to do? I don't know.
There's a word I can't say on television right now that I'm thinking, but it's
cable.
It's like nonsense.
I say go for it, and then
I would say that's
worry about it after.
Bullshit-sue.
Yeah.
Okay.
Exactly.
You can say that. Just call it a dog.
That's what I've been told. I'm just explaining.
It's nonsense.
Don't shoot me.
It's nonsense. It's because we have 50% of our debt. We have $32 trillion in debt. 50% of it matures in the next 3 years. The weighted average coupon is 2.5. A year from now, our interest expense is going to be more than our defense budget. This is the time. I don't like the. I don't. To the extent to which the yield curve, because of quantitative easing, has been manipulated for the past 14 years.
You're saying the fiscal side should
There's
respond.
a reason, in my opinion, the fiscal side should follow suit. This is the time to do it. But
I think the late great Sam Zoll broke the glass ceiling.
On that word, could we just ask Jason about stocks?
He didn't use it as a dog. He didn't say a dog. He actually used the.
He used the real.
Jason, can you give us 2 seconds, 2 minutes about the stock market right now? Are there places where you'd like?
We don't have 2 minutes.
Well, I'll give it
30 seconds.
Listen,
2 minutes.
The place that I'm most excited.
I'm being like,
we don't have 2 minutes. We're like the Fed.
The liberal.
Just print time. Yeah, who cares? With MMT.
Now you're taking his time. We had 2 minutes. Now he killed it.
I'll keep it quick. I think energy is one of the more interesting parts of the market now. I still do and actually, if you look at technically, there's more companies above the 200-day moving average in the energy sector on a percentage basis than there are in the technology sector. Again, the Magnificent Seven, I would say they're sui generis. That's a whole other deal. But I think that's one place where you're getting a lot of cash flow, and companies, in my opinion, dividends,
that are
share
competitive
repurchases,
with the 2 years.
And for the first time in my lifetime, energy companies are good stewards of shareholder capital. I mean, usually, these guys are put on earth to punch holes in the ground. That's been my experience up until the last couple of years, and now they're actually saying, like, "Gee, we want to return money back to the shareholders."
Exxon was big in the PC and the fax business in the 70s.
Yeah.
That's how Lee Raymond made his name, was getting them out of that stuff.
Right. So, in my opinion, that's one place investors can look to find some real value.